Alright, let's continue for chapter 5. This is the second video. Okay, so I wrote down here how to break down the interest rate. One of the component for interest rate for market returns to the bond holders is called inflation premium. How to calculate it? Well, you can just check the website for the inflation is how much it should be provided by the Federal Reserve. Also, you can use tips to calculate the inflation premium. Tips is a kind of treasury security, but you can Google and find the definitions for tips. It should be inflation free. It's a type of securities not considering the inflation premium. So tips, the returns to the tips or treasury security, one type treasury security called tips, the returns to tips should be like real interest rate, like here, like this real interest rate. So for other treasury securities with similar terms like tips, and you can compare the yield to those treasury securities and compare them with the tips, and the difference will be the inflation premium. For example, both are 10-year treasury securities. One is tips, one is just treasury securities with 10-year maturity, and then you can compare the yield and you can figure out the interest premium in the next 10 years is how much. So that's expected inflation premium. Okay, interest rate risk. Interest rate, because bond prices are driven by the interest rate. Interest rate goes up and bond price will fall. So there's always an interest rate risk. Interest rate is controlled by Federal Reserve. So when investors buy bond and you don't know the future interest rate will be how much, because it's not market, it's not controlled by like the market, it's controlled by Federal Reserve. Reinvestment risk refers to like the companies, the investors receive the coupon, and for example, receive the coupon when market interest rate was low, and then investors needs to reinvest it in the bond market, but interest rate is so low, so that's putting investors at a position which is worse off. So reinvestment risk is another major risk bondholders has to consider. Interest rate risk will be more important to long-term for investors who's holding the long-term bond, and reinvestment risk is more important for investors who's holding short-term bond. So what's bond rating? We all know bond has a rating, right? The AAA is for U.S. government bond, and for the next one, AA, like Walmart bond, will be rated like AA. We can use this Z-score. You can click on that link to find more explanations for Z-score. Z-score tells the risk, how risky it is by considering several factors. And then the higher the Z-score, and then the riskier it's supposed to be, the company is supposed to be. And then and the higher the Z-score, and then the rating of the company should be lower. Okay, so also you see the bond rating considers factors. The major factors considered are like debt, leverage ratio, coverage ratio, profitability ratio, liquidity ratio, and more. So anyhow, so it's based on those ratios, based on the Z-scores, and then the ratings will be given. The higher the rating, and then the lower the default potential, and then also the lower the return. Investment grade include the bond with triple B and better bond, and junk bond will be considered like anything under the investment grade bond, and returns will be higher to junk bond, of course, but it's riskier. Okay, so so you can see this is a summary. This is a summary for bond ratings. You see the top one AAA and the bottom one CCC. You see quite a difference for these ratios. Okay, MRP is maturity risk premium. This is how to calculate the maturity risk premium. The longer T is how long the bond will be matured. The longer it is, the maturity risk premium should be higher. But these are not required for the calculations for this chapter. But anyhow, just for information. Okay, also yield curve. Yield curve. Yield curve is just like putting all the yield of different maturity on a graph to compare the interest rate with short-term bond and long-term bond. So that's how it is. How it is done. Okay, so then you can see here the normal yield curve should be upward sloping like this. Shorter term bond yield should be lower than the longer term bond. So this is the economist normal, and then the yield curve should be upward sloping. It should be like this. Okay. Anyhow, so this is yield curve. This is summary for different types of treasury, different types of bond, what kind of components it is included in its calculation. Short-term treasury. ST is short-term treasury security. It has inflation, but no maturity, no default, no liquidity premium. For long-term treasury security, well, have to consider, we have to add the maturity premium into the yield of long-term treasury securities. As compared with corporations, bond, they all have default risk. They all have liquidity risk premium. So the returns to the corporate bond should be higher than the treasuries. You see more components are included in the calculation. Okay, so this is the difference. Usually we consider the spread. We use the corporate bond, subtract the treasuries bond for the same maturity bond, and then we look at the spread. We look at the corporate bond yield spread, and it equals to default plus the liquidity premium. Usually it should be like this. The treasury security return, and this is a yield curve. Treasury security is the bottom one, so its yield for all terms should be the lowest one. The lower the rating of the bond, its returns should be higher because it's more risky. It's riskier. Okay, so if the company is liquidated, what will happen to the investors and to the investors of the company? So bondholders, you see, if the company is liquidated, and past due property tax has to be paid first, and secured creditors should be paid, and then trustees' cost, and then unsecured creditors will be paid after a lot of creditors will receive their payment, and then preferred stockholders will get their money back up to the par value, and then common stockholders are left as the last group of investors to get paid usually nothing. Okay, so and that's a quick review for this chapter. Okay, so thank you for watching. Have a good day.